This is our navigating tax time for building and construction. It's a bit of a joint effort today, but very grateful that Jules is co-hosting today from Build Xact, and we always welcome the support that you guys give us, and we've also got Craig from Hazard Co, who Jules will introduce in a minute. He's going to give us a bit of an update from his perspective as well at the top of the show. But Jules, maybe I'll throw to you just to start off with.
Yeah, thanks, Phil. So there's a stack load of Build Xact customers on this webinar. Just for some context, and I'll get to the sort of point of why I'm bringing up this in a second, but I used to work at MYOB. My role there was basically to work with bookkeepers and accountants, and this is going back sort of seven years. I was there for about 5 years or so. And one of the issues that I was always trying to get these bookkeepers and accountants to focus on was you need to specialize in a particular area that you're working in. Because what I used to see was people were in hospitality, trade and construction, manufacturing, retail, etc., etc. And the problem is those guys just are spread way too thin to know the apps, to know all the different complexities that industry has. And working with someone that works with a builder, for example, where they've got hundreds of thousands of dollars moving through their bank account every few months, versus a cafe or a restaurant, it's not the same problems, it's not the same level of staff management, it's not the same turnovers. All those things are completely different. The apps they solve, everything's completely different. And one of the real struggles that I always found was trying to get these people to understand. And they were like, well, I don't want to turn clients away. And it was like, but if you focus on a particular area, you will offer better services and knowledge to those people. And that was such a struggle. Like the majority of people just didn't get it. Now you are starting to see people starting to get it. You see bookkeepers and accountants sort of specialize in a particular area. Just took some people a really long time to actually realize they need to do that. And the point being is, the reason we promote Xact Accounting a lot, and the reason we work with them so much, and the reason they help build some of the areas of the product with us, is because they know their stuff. You can insert another word there if you want. And that is so important, especially in this particular space, because it is so much money moving through people's business that you really need to have people in your corner that actually understand this space. And that's the same thing from marketing. Marketing a cafe versus trying to sell a $1 million house. They're two completely different things. So someone that's just a jack of all trades, master of none, isn't really going to help take you to that next step. So again, that's kind of why we always try and work with Xact Accounting when it comes to these sort of topics or anything profit finance related, because they know their stuff. They work with builders all over the country. So they're very, very good at giving the specific advice for builders, not an advice that is just a general look up. Now, if we've got an accountant or bookkeeper on here that doesn't specialize, I do apologize if you think I'm throwing a bit of shade at you. I'm not intending to. It's just trying to give the best possible advice to our builders and the builders in the space, because all of us here are really passionate about trying to help you guys be successful, because that obviously props the whole industry up. So bit of a long intro there in terms of why I think Xact Accounting are bloody awesome. And yeah, just I'll send you my bank details later on for the deposit, Phil.
Well, I think the point you're making is a good one around specialization, and it's not just us. There are others around as well that have an active interest in building and construction. And I guess we would just advocate that whoever you're using in this side of your business, that they do understand the dynamics of the industry, because it's pretty important. So thanks, Jules. I'm going to share my screen, although maybe at this point it might be good. We might just throw to you, Craig, from Hazard Co, also another one of our sort of valued partners in the ecosystem, who do amazing stuff and has really transformed what is a pretty challenging space, safety in the workplace, and made it something that is just so much more functional for everyone. Whether you're the subby turning up or you're the owner of the business trying to make sure you're compliant, we think Hazard Co is an awesome product. But yeah, we thought we might just get your perspective, Craig, around systems and process, and having all that good stuff plugged in properly.
Yeah, thanks, Phil. So I think safety is a bit of a grey area, kind of like tax, right? It can be a bit of a grey area. I think, but as you said, specialists are important, whether you're using an estimating platform or quoting platform like Xact, or whether you're using a safety platform like Xact. It's important that as a building company or as a trade company, you're working with specialists that understand that area of the business. There's a lot of tools out there which do everything apparently, but they probably satisfy only a subset of the needs rather than satisfying all the needs of a subset. So I think we love working with you guys because you are specialists in that space, but also it's important that we have systems and processes in place, especially around this time of year, to ensure that businesses are optimizing their day-to-day and their full financial year. And that includes, your cost of health and safety, or, the cost of whatever software platforms you're using. It's important that you take all that, because it's really important for your business, and you go to guys like Xact Accounting and you work with them to understand, how to optimize all those costs within the business. So, I think just to echo the specialization piece is, it's so important.
Yeah, absolutely. All right, Craig, thank you. I'm just going to share my screen. Hopefully that works for everyone.
I'm going to turn my camera off, guys. You don't need me giving you tax advice, because I'll get you in trouble. So I'm not going to comment too much from here.
It's in Julian's contract that he cannot talk when we're talking about tax. Okay, just a little bit of housekeeping at the top here. So what we're going to cover today, we've done the Xact intro. We're going to go through largely two kind of main areas. So tactics around, how you might approach things like purchasing vehicles, that kind of expensing piece, and how do we go about claiming for that. So some tactical stuff, including for those on the call today who have any kind of accumulated tax debt, we're going to speak to some of that as well. And just some things for you to take away as we get into the end of financial year. Then we're going to change gears a little bit and talk about some of the more strategic levers around tax, and particularly things like SMSF. How do you structure the business so you get the best profit, the best outcome when it comes to tax, but also in terms of protecting your assets as well. So we're going to talk to some of those bigger levers, and through the lens of family wealth and how that might be structured from a family group perspective, and then from a property development perspective as well, because we know a lot of builders, tradies and the like to sort of play in that property development space. So we've got some coverage of that sort of content as well today. Questions, please drop your questions into the chat. We've just shown that the chat actually works. So drop your questions in there as we go. There's some sections as we go throughout today where we'll come up for air and answer some of those questions. We'll also try and answer them in the chat where we can too. As Jules said, make sure you've got everyone turned on for the chat. You can send it directly to the panelists if you don't want to out yourself with your question, but it's a safe room here. And I think if you've got a question to ask, then other people are probably thinking it as well. So if you want to put that into the chat. We're going to be we've got an ebook that we've built out of this content as well. So we'll be sending that around at the after the show, along with the video of today's webinar. So if you miss it, if you have to run out for whatever reason, we will be sending that around afterwards. And we've got some polls throughout just to kind of keep things interactive. We're going to run one in a second, but we also have a poll at the end where you can book a complimentary consultation, where you may want to review your structure with the guys. We're happy to do things like that on a complimentary basis. Or if there's anything we've touched on that you feel like it might be better on a one-to-one basis, asking the question that you might want to ask. That way we can look at your specific situation as well, rather than the more general approach that we've got today. Very, very quickly, Xact Accounting, we've got 3 different divisions or 3 different broad service offerings that we offer. We offer a bookkeeping service, which is very much about system integration, making sure Xero, Build Xact, all of your platforms are talking to each other, and you've got good, efficient workflows in place. You got high quality, accurate data in your world. CFO advisory, which is all about margins and profit and looking to the future, trying to understand things like, forecast to complete jobs, job by job margins, and really healthy reporting around that, but having a partner alongside you to give you strategic advice about how you're going to grow your business and protect your margins. And then the final service, which is very relevant for today, which is compliance, which is really about tax and structuring, as well as any of the sort of state-based home warranty and licensing regimes that are out there. We really specialise in that space as well. Before we go, though, just letting you know, or before we get going, this is a little disclaimer to say that this is general information. If you are going to make any big decisions, please make sure you consult your accountant, potentially a lawyer as well. And this is really just informational for informational purposes today and general advice. Our presenters, Josh and Dylan, apart from being fabulously good-looking young blokes, they are also, really some of Australia's best and leading accountants in the building and construction space. This is what they do all day, every day, and long days as well, because we love working. And so their experience is what we're going to lean on today. They've both had long careers in this space and really understand the complexities that come into play. And can I say, guys, just absolutely love doing this stuff as well, which I think is an important ingredient as well, that you're just really into it. We're going to quickly run a poll, our first poll for today. If I can find my polls. Here we go. This is the first one, and it is about your current tax position. So, and these are anonymous. We're not going to share anyone's names here. It's really just to get the juices going. But tell us, how would you rate your current tax position? Do you feel exposed? As in, I'm really not sure. Adequate? I think it's okay. Good, but could be better. So you're probably starting to, get some okay advice and structure things well, but really think there's some room to move there. Or you are fully optimized. Things are absolutely where they should be. You're on top of all your obligations. You're well structured. You're going to be able to cater for growth in the business as you scale up and start to drive those, super profits, which is what we want. You've got a really good plan for how to deal with those. So just a little poll there to get us going. And then the next one was, how confident are you with tax and business structuring? So where are you at that, I guess, tax literacy with that? And then where do you get your advice from? Is it DIY or the other end of the spectrum, which is, my accountant really understands building and construction. I'm getting specialist advice. So that's that quick poll there. And I reckon, guys, we might get on with the show. It is over to you. Dylan, you can take over sharing the screen, mate.
Thank you, Phil. That's everyone can see that. It's come through okay?
Yep, got it, mate.
Yep, cool. Yep. All right, so the first one we'll run off. The first couple of topics are probably on the drier side. They're your more traditional 30 June preemptive tax planning items. So the first one we're talking about is purchasing a car. So the instant asset write-off this year is only 20,000 plus GST. So cars are pretty much out unless you get a really nice or not nice car for under that amount, which means we're going to have to depreciate the assets that we get. We don't have the instant asset write-off for it. Now, most of the vehicles that are our clients, obviously building construction, are looking to get are predominantly utes or what the ATO sees as workhorse vehicles. So provided they have a 1 ton carrying capacity, they're actually not subject to the luxury vehicle or depreciation limit, which at the moment is roughly 80,000, excluding GST. So we've got a bit of a worked example where we're purchasing a vehicle through the company, and then the comparison between if we're going to do a logbook because this feeds into our next topic of fringe benefit tax, where if we were to purchase, say, a Hilux single cab, it's only 50,000 or 51,000. We get a logbook or a tax deduction for 17,000 under the logbook method, along with the ability to claim GST of 4,600. Now, if we compare that to the cents per kilometre method, which is capped at 5,000 kilometres per year, we only get a tax deduction of 4,400. So the logbook for vehicles can be a massive difference in depreciation. Deduction. So the tax saving on this one is a difference of about $8,000, which is pretty good outcome. Now, on the theme of motor vehicles, is obviously fringe benefit taxes. So FBT is the tax on private uses or private expenses within a company. The main one we'll always see in our clients will be vehicles, the vehicles and entertainment. Now, FBT is I guess a tax on private use and effectively doubles how much you're going to pay in the company. So avoiding FBT is pretty critical, and the reason why we look at workhorse vehicles or one-ton carrying vehicles is they're not subject to FBT. So we don't have to apportion for private use, regardless of what the asset is actually used for. This one can really come back to bite you a little bit. The ATO had been rather lax on chasing it up, but now we're seeing the ability for the ATO to data match cars registered with Main Roads versus what's in a company's name, and then also what's lodged in the company tax return. So the main one that's going to get caught is the family car, where the builder or the husband might be driving around in a exempt vehicle, so a Hilux, a BT50, whatever it might be, but they've also got the family car in the company as well, which has a much smaller private use and it's not exempt from FBT. So suddenly we've got this adjustment where, yes, we get the tax deduction, but now we have to pay it back for the private use. And historically, ATO would leave you alone, but now they're going to be much harder on this with all their ability to data match between the different government bodies.
We're actually getting letters, aren't we, Dill? So we're actually, the ATO are actually writing to these businesses and saying, we know you have a Nissan Patrol in your company and you haven't reported it on an FBT return. So it's all the insurance and Main Roads departments are all very much reporting this data now. So FBT used to be able to be much more easily managed, didn't it, Dylan? But now the ATO are all over it like a rash. Yeah.
So it really comes down to, and if you think the luxury or the bigger Rams or the American utes that are predominantly used for towing. So towing capacity might be 4 tons, 3.5 tons, but their carrying capacity is relatively lower. They might be 700 kilos. They're actually not exempt from FBT. And going back to the depreciation, they're also subject to that limit of 80,000. So it might be prudent if you're looking at a Ram, a Silverado, or one of the bigger utes that don't have the carrying capacity to look at a GVM upgrade before it. So sorry, let me just look at the questions. Yeah, so carrying capacity is the one that the ATO deems not towing capacity. So GVM, payload, whatever it's referred to, but the ATO refers it as carrying capacity. And when don't you need a logbook and still claim fuel and rego? If you're talking about a company asset, that would be, if they're exempt from FBT, that you don't need a logbook for it. But an individual, so just an employee claiming their car, will always need a logbook if you want to go the operating method. So hopefully that answered those two. So other 30 June EOFY opportunities from a tax point of view that we're sort of running with our clients. Accounts receivable so if there's debts that are sitting in there that are unlikely to be collected, they're going to fall into your taxable income. So when you do a tax return as a bigger business, it's always on the accruals method, which includes debtors who might owe you money. So if you're sitting there at 30 June and you've got 70,000 of someone who's not going to pay you or extremely unlikely to be received, well, we'd be recognizing that as a bad debt before 30 June so that we don't pay tax on that amount. If they later, let's say legal proceedings go well and it later comes back around and they pay 50% or 60%, then it's recognized as income then. But we have plenty of, unfortunately, clients that just have debtors that are just lingering and there's no point leaving it around and paying tax on it. As I said, instant asset write-off is only 20,000 plus GST per asset. So the main areas are going to be sort of your tools or specialized tools, maybe trailers under that amount. But most of the vehicles out there in the market are just going to be above this threshold. It doesn't look like it's been extended for another year now with Labor getting in. So 30 June 2025 might be the final year for this. So if you're likely to need some sort of specialized piece of equipment in the next 2, 3, 4 months, then you're better off bringing it forward and get the tax deduction in full in this year. Employee super, so paying your actual employees their superannuation, which is due quarterly, so it's not due at the moment till 28th of July, the June quarter. If you bring that forward and pay it before 30 June, you actually get the tax deduction in full.
Think we lost you there, Dill.
Something has not.
Yeah, can you?
You're back now.
Yeah,
You're back.
yeah. My Bluetooth, since my daughter got her hands on it, it disconnects every now and then. Sorry about that. So yeah, employee super is deductible when paid. So bringing that forward, that deduction forward by 30 days and paying it before 30 June, you actually get the tax deduction 12 months earlier. So you're going to spend the dollars anyway. So if cash flow permits it, you'd bring that expense forward. Subsequently, timing of expenses. If you receive the exact same reason with the first point, where tax returns are prepared on the accruals method, if you invoice materials that might be getting used in the July, so your stages of work in July or August, if you receive the invoice or have the invoice processed within Xero in accounts payable, we still get to claim the tax deduction of that. In terms of your QBCC ratios on the back of it, work in progress can be measured and adjusted so that your current ratio is unaffected. And work in progress, so there is a specific tax ruling that allows us to make that adjustment taxable or not. So bringing your expenses forward before 30 June, again, similar to super, you get the tax deduction 12 months earlier because it's in the 2025 return. And then also, most of the business cap, Josh, what's the turnover threshold on prepayments? Is it 10?
Yeah, it's like normal small business threshold.
Yeah. So it's a small business threshold. If you're under 10 mil turnover, you can actually prepay expenses, and provided it covers a 12-month period, you get the full deduction when it's paid. So insurance, even accounting fees, if it's prepaid before 30 June, then the full amount is deductible. So it can be, again, if you had a position where you had excess cash in the company and you're going to incur expenses anyway, well, then we look at the timing if we bring it forward and have it included in the 2025 tax return. These are like the easy sort of adjustments that don't require much thought behind.
Yeah, the only cautionary one on the super fund one is make sure that you actually push the employee super with enough time before 30 June. Don't leave it till 30 June to go, we'll pay employee super, because it needs to get through clearinghouse. So if you're using Xero or whatever, and you're using either small business clearinghouse or Xero's clearinghouse, you need to give yourself enough time. So I would say that Xero usually are quite conservative and say do it way earlier, but really you probably want to be pushing it by the 23rd of June for it to get through enough clearinghouse time to actually get to the super bank account.
So for example, with the March quarter, because March was due in April obviously had about 17,000 public holidays through it. Xero actually said you would have to process it by the 10th of April for it to be paid out of Xero by the 28th of April. So they had a 2-week lead time there. June, obviously, not any public holidays in there, but you never know. You're sort of at the mercy of Xero or, other clearinghouses.
Cool. Thanks, Bill. We've got onto ATO debt management. So we touched on this just a second ago. And it's actually a very hot topic now because the ATO, you may have seen the ATO getting pretty aggressive now on capturing their tax revenue from prior years. And unfortunately, particularly building and construction has had a walloping over a number of years. And whilst there's probably some fruitful time right now, there are still a bunch of hangover debts kinking around. And now the key thing I want to really get in front of your mind now is the ATO have specifically said that from 1 July 25 this year, the interest, like the ATO interest on outstanding debt, will no longer be tax deductible. And that's a very big financial outcome for people, because the interest rate's quite a big interest rate with the ATO. We're sort of close to 12%.
11.2 as of today.
Yeah, 11.2. So it's a big interest rate, and if we're not getting a tax deduction for it, that can be a big long-term cost, and will just take you a lot longer to be able to get through your ATO debt. So one thing I want to be putting in front of you now, we'll send out some information as well post the webinar around looking at refinancing options, right? Because when we're talking about business debt, you can borrow using other sort of like bank funding, etc., and pay your business ATO debt, and that interest on that debt is actually tax deductible. Just that the ATO specifically said that their interest is not going to be deductible. So I think it's a very key point, if you've got some lingering ATO debt, to start thinking about how you might be able to leverage debt a bit better to get a better overall tax outcome by managing your ATO debt. There'll be plenty of funders out there. Obviously, the big four banks will be nervous in some areas on this, but obviously if there's real property involved, they tend to have the flexibility there. And ATO aggression on outstanding debt, we're seeing it come up a lot, even if the debt isn't outstanding for very long. We're seeing the ATO issuing direct penalty notices faster than ever on debt that actually hasn't been outstanding that long. So the key point I want to make here is don't let ATO debt be sitting unmanaged. If you're on payment plans, fine. You have to make sure you keep complying with them. But the big thing you need to be looking at, particularly if you've got an unfortunate position where you've accumulated debt, it's tax cash flow strategy. So you really need to have a look at how we're cash flowing out, managing our tax debt. If your tax debt isn't currently on a payment arrangement because you've had trouble doing that, it's something that just needs some attention really quickly. So I just wanted to make that point, that there's a bit of an opportunity there, as well as a cautionary tale going, don't forget about the importance of managing the ATO debt. Now, the next point, I'll just touch on this, the small business restructuring process. So if we've got to a point where you've got some hangover debt and you're just struggling to get a sort of a top of it, and most of the time it is the ATO that have accumulated debt, there is a process in our system, was passed back in January 21 in response to COVID, to actually do a process to significantly reduce the debt. So it does fall in the categories of an insolvency process, but it's a much lighter process, and you don't lose control during the process. So the key criteria are that we need to have 1 mil in overall unsecured creditors. It needs to be less than 1 mil there. Super must be paid. Now, this is the key thing. If you've accumulated a bunch of super as well, you need to make sure it's paid to be able to do this process. Another one, which Dylan's about to touch on very shortly, is direct lines need to be managed. They're a very big topic area when you're trying to manage debt, particularly if you're asking the ATO to take cents in the dollar. And the key thing, as I said, you do not lose control. The key around not using control is that it's not counted as an insolvency event for the regulators like VBA, even in New South Wales or Queensland. It's not counted as an insolvency event for that purpose. It doesn't mean that it doesn't impact your home warranty in those states, but the key thing is it doesn't mean you lose your license. And the whole purpose of it is to offer cents in the dollar, and you pay it over time or up front, and you sort of get a bit of a breather on your debt. So any more information on that, you can reach out after the webinar, but it's something to sort of park in the back of your mind if you have landed in a tricky spot. Now, we got any questions kicking around at this point?
Yeah, so there's two. So does the interest or non-deductible of interest apply to companies? And it applies to any ATO debt. So
any ATO
trust, GST, pay-as-you-go withholding tax.
Right. The other thing to be very mindful of is, whilst the ATO are happy for you to borrow money and pay ATO debt for businesses, individuals, they very specifically do not allow you to borrow for personal debt, individual debt, and claim the interest. It's a distinction between business and personal, and the ATO have a long-standing view that it has to be business-related debt, so i.e. companies and trusts is really what they're getting at.
Yeah. And then, so the interest changes from 1 July. So if you're on a payment plan for debt that precedes that, the interest up to 30 June will be deductible, and then anything after that non-deductible. So the ATO effectively did it as most people were using the ATO as a bank. They said no enough. That's why their interest rate is higher than anyone else. And now that it's non-deductible, they're effectively forcing you to refinance to pay them out. Because I think they went through COVID, ended COVID with 50 something bill in debt, went hard on debt recovery for a year, ended up with more debt. And then the number recently was 100 and something bill in debt, with 60 or 50 or 60% of that being recoverable. So they've gone really hard on then debt collection, which is back on that. The aggressiveness is those director penalty notices come out thick and fast now. And then the other question was, I guess the word restructuring. Josh, if you want to touch on that. So what do you mean by restructuring?
Yeah, it's all it really means is it's debt restructuring. So, i.e., you're just looking at your debt and restructuring it to get a haircut on it. So that's all the phrase means. So you're not actually changing business structure or anything. So that's a fair question. It's just debt restructuring in that business. So it's a funny phrase in this context, but that's all that means.
Yeah. And ATO interest is applied monthly, calculated daily. So when you do a payment plan, they'll know, like, that's why it's not the total debt divided by, say, 24 months. They normally add interest on top. So they work it out, but they actually apply it to the account at the start of every month. Any other questions on everyone's favorite ATO?
Looks good. I think charge on.
No, I think we're good, and we probably need to just get cracking to get through the rest of this content. Yep.
That's okay. All right. So moving on to I guess now, how do we get the money out of the company? The company's generated profit. Company's tax rate 25%. How do we get it out personally and spend it? So the three main options: wages to the directors, dividends to, say, that the shareholders, whether that's a trust, or then director loans or loans out. So a good example or a visualization of a use of a trust is we normally set our clients up as trading as companies. It's just the lowest tax rate, asset protection, all of that good stuff, with the shares held by a trust. And the reason why we do that is it allows us to say, well, the owner might be working in the business, or the director is working in the business. He's on a salary of 100 grand. What do we do with the other 100K in profit in the company? That then goes into, well, we can pay it out as a fully franked dividend to a trust and distribute it to someone who's no longer working. So if I do the comparison, and this is a comparison of a sole trader with 200,000 of taxable income, they'll pay tax of roughly 60,000, versus a company and trust where we have the ability to use fully franked dividends. So company will pay tax at 25%, but then we pay a fully franked dividend to the trust, and our net tax across the group, so between the individuals, so husband and wife, same 200,000 in profit, is 45,000. So the exact same amount is received as taxable income, but we've saved about 14,500 in tax moving forward. That's structuring from the start. Sole traders, just when the business kicks up, that top tax rate of 47% hits pretty hard. The only thing with trusts, the ATO has cracked down recently on distributions to adult beneficiaries. So normally the 18 to 22-year-old who's studying at uni, not earning a wage yet, were very good beneficiaries that we could use. The ATO now says no, the cash has to physically be paid. So if you use a child or an adult child, the trust has to physically pay the distribution to them. The second point in our world, obviously in building construction, is most licensing bodies don't like trust, which is why our trading entities are never trusts. Like QVCC themselves won't license the trust. That's the same with in New South Wales and Victoria as well. And actually WA. So that they're the limitations in trust. They're normally used as investment vehicles. All right, my favorite topic, Div 7A, so director loans. When the money comes out of a company and it's not a wage or a dividend, it creates a loan from company to directors or related parties. The ATO doesn't like that. So they say they put in a tax act called Division 7A, which means that the loan must be a complying loan at their benchmark interest rate, which currently is 8.7%. It's normally 2% above the home loan rates. and it has to be repaid to the company over 7 years. Now, that repayment can be physically paying cash back into the company's bank account by 30 June. It can be wages or recognizing wages where you've effectively already taken the money, and this is now the taxable event, and there's super implications on wages there, or dividends, which might go through the family trust and distributed out through the family group. Div 7A, the ATO doesn't like. When you look at the SBRP or the small business restructuring process, if there's director loans on the balance sheet, the ATO is going to have a massive issue, because effectively you've racked up a bill with them, taken the money and used it personally, and now saying, hey, I want to pay you 30 cents in the dollar. So I would avoid Div 7A as much as possible. This is probably a basic example where John's company, so John's a trading and the family car breaks down. So effectively need to buy a non-company asset. And instead of getting an external loan, or they don't have the funds personally, they take the money out of the business and buy the car personally. That then creates a loan from company to John and his partner or his family under Division 7A. So now John, well, effectively the company is the financier, and John and his wife are going to pay it back over 7 years plus interest. So it can work really well, and there's strategies around Div 7A. But I mean, our view is generally the business should be able to pay you a livable wage where you're not then drawing on top of it, creating a loan from company to individuals, so that we don't have these massive Div 7A loans. Because the issue is you do it 1 year, it's okay, I guess, you can deal with that. You do it a second year, a third year, then you might have 3 or 4 Division 7A loans, all with 7-year repayment terms, and it becomes extremely messy, extremely fast. So I'd be avoiding it. Now, Div 7A it applies to every company, but it's still pretty widely maybe not understood or not respected.
Yeah, it's been around a very long time, 97 since we've had this around, and it's still not done well. But there is opportunities in Division 7A as well. I might charge on, Phil. I know we had a question section, but we might keep going for the minute.
Yeah, there's nothing in the chat there, so I think let's punch on. Yep.
Let's punch on. Property development. Now, I'm not going to go deep into this because we have an entire webinar on property development, and I encourage you to have a look at that, and you'll see our resources page after this. But the key thing with property development is there's opportunities as well as things not to forget about in the tax arena when it comes to property development. So the key pillars of property development, the first one really is, what's the purpose of what you're doing this for? Now, property development is a very broad phrase, so it can mean doing up your home and increasing the value of the home, and maybe you sell your own home and get some uplift in that, fine. That it's all the way from there to building a $200 million, multi-story building, right? Property development sits somewhere in between there in sort of a spectrum. You need to know what the intended purpose is. So whenever you're developing a property, you need to be thinking about, is this actually for a long-term investment purpose, or are we just trying to make some profit out of the property development game, which is a very fruitful game to be playing. But there are some things that you need to be aware of, that when you're in the property development space, particularly when you're creating new property or building a new property, GST very much applies in this space, and you can't forget about your GST obligations, because I would hate for you to do the property development, not factor the GST in when you sell it, and at settlement you'll have 7% of your sell price sent to the ATO. So do not miss out on GST. Happy to unpack that with anyone after the session on a separate one, but that one is a key one. And the CGT, or capital gains tax regime, again, we need to be acutely across what the intended purpose is. And if we're doing the main residence exemption, that's a very complex area, the main residence exemption. So as you might know, selling your family home doesn't attract tax generally, but you do need to be very careful when you're doing property development. So have a look at our whole webinar dedicated to that. Now, super, just let me flip into the super sphere. So I'm not going to talk about whether you should or shouldn't do it in this instance. I'm just going to give you a framework for what the tax arena looks like for superannuation, particularly making contributions. So there's two sort of core areas of super contributions. We've got before tax or deductible ones, and after tax and non-deductible. For the purpose of this, let's really focus on concessional contributions. So concessional includes both the 11.5% like employer contributions on salaries, plus anything else you put in to a super fund and claim a personal tax deduction for. Now, the general cap on this is $30,000 a year, where you can get a tax deduction for it. Now, across the years, we've had a bit of legislation in place that if in the last 5 years you haven't completely maximised your contributions cap, there is still the opportunity for carry forward concessional contributions. So if, particularly if you're out of workforce, or you particularly contractors where they start out as subbies, as sole trader, and then may come into this sort of a structure with a company on wages, there is an ability to top it up. So that could be, circa 80,000 in some cases as an example. And if you've had a very good year, cash flow permitting, you may be able to put in more than the 30,000 cap and claim a tax deduction at the company level or individual. So that's a good opportunity. Definitely have a look and have a chat to your advisor around whether that's something to be looking at, particularly around the carry forward, because if you don't use the last 5 years, you will lose the years that you haven't been using. And non-concessional is really if you want to top it up, but that's usually after-tax money. Now, next bit, I'm just going to let this float here for 5 seconds. Disclaimer, self-managed super fund. I am not saying you should do it. This is general information and just need to have a think about, and we'll just talk about the use cases of SMSF that we see after clients get financial advice. So the self-managed super fund sphere is very attractive, and I'll just get these points out here quickly. The whole idea of it, it's self-managed, you take control of your super. Obviously that's an opportunity, but also you need to make sure that you understand self-managed super properly, because you are now the person that is in control of it. Common use case for our client base is commercial premises. So the building company might need a bit more storage space, particularly if the materials, etc., and vehicles, using the super to actually buy commercial premises. The key thing is there are very strict rules around super. It is providing for your retirement, so it's very much locked down, and so it needs to be dealt with very properly. You can borrow in super, very specific way of doing it, and it needs some very careful planning and structuring to get that right. We've done a few of these working in concert with financial advisors. The key thing, why super? Super is probably still the only tax environment where it's the lowest tax you'll see in our system in terms of all the earnings in super, tax at 15%, and capital gains in super tax at 10% ultimately. So those sort of tax rates are pretty good, but clearly it's a very locked down arena, self-managed super or super generally. So you won't have access to it for a very long time. Particularly if you're in your early years, you won't be touching it until 60. Here's the quick example. So if you are just with SMSF, we're looking at what are we saving in terms of tax here. So the building company on the right, you can see here, has a good operating business. It pays rent to the self-managed super fund. So you're taking the rent of 50K, you can see here, pretty much out of a 25 tax environment and putting it into a 15% tax environment. And it's for your own actual investment as well. So it's a win-win in terms of getting a tax benefit as well as providing for your own retirement on an asset that you tangibly can see and feel and can be used. The key thing is, though, it does need to be business real property. So you can't just have a house and use it. It does need to genuinely be a business premises, commercial premises, warehouse, or an office. So there's a bit of tax saving on that front there. Phil, do you want to run a poll quickly before we get into structuring?
Yep. My video is coming back on slowly. Here we go. Okay, so we're going to talk about structuring. And before we do that, I just want to launch this quick poll now. So one of the things about structure, and we see this all the time, is that, people start out maybe as a sole trader, or, they're, for some reason, accountant talks them into doing a trust, and they're trying to trade out of that. But for whatever the reason, people don't necessarily revisit the structure that they're in, and it's really important that you do that. Not only are there great outcomes from a tax perspective and some great forward planning opportunities there, but also from an asset protection point of view, particularly as you get involved in things like property development, making sure that if projects don't work out, that there's no impact back to your original company or your personal assets as well. So there's some important things to consider there when it comes to structure, and it's something that you should really be looking at on a regular basis with your accountant. So just a quick thought-provoking question there around how often we want to be looking at structure. Okay, I'll close that poll off now. Thanks everyone for answering that one. And Josh, back to you. Oh, I think it might be
Dylan. Dylan can grab this now.
Yeah.
Do you want to answer this question? Because I think it will. Most people will ask: can the purchase of the commercial property in the SMSF be part SMSF, part private funds?
As in jointly owned, or as a mixture of how you borrow?
A mixture of how you borrow it, or jointly owned, either or.
Yeah, you can jointly own property with super and still borrow. Again, complex area, you need to get it right. Can be done as the short answer, but you need to talk to myself or an advisor to get it right. In terms of using private funds, the real trick in this, and I'm happy to unpack it at another point, is Division 7A is actually quite a clever technique to use for this. I might plant that little nugget to circle back to at another point, but you can do some very clever things with that. So, Melody, yes, you can. Happy to talk about it after this.
Yeah. And then Ben's just asking about examples of structures. We're about to do that right now. So,
right now, Ben.
We're going to crack into that.
So we'll jump in. Sort of more when you start off and setting up as a trust. Some businesses do well in trusts. It's just not building construction. No licensing body likes it, which is why we just don't look at that. But they're sort of, when the business is more mature, it's not just starting up. That's when we start looking at sort of doing the more complex structuring. And you mentioned there, sole traders are out pretty quickly because of the asset protection side of building construction, but also the tax rate. Subsequently, when we start thinking, all right, healthy profits, we may be looking at property development, or then we're looking long-term, either wealth creation or succession planning. Well, then we start looking at a more complex structure. So a good example of one where, and let me just draw on my screen, this structure here, the bare bones that we will always have is a trading company. And then we would all ideally like the shares to be held by a trust in some description. Reason being is we've got 25% tax rate up here. This entity, obviously the building construction entity, would pay wages to the director, might pay wages to both. But let's say this individual is already in the 32% tax bracket, which is 45 to 135,000. Now we have the ability to say, all right, I want to pay a dividend out to my spouse who might have no taxable income in this year. I've got the ability to do that via the family trust. Subsequently, we look at a holding company because outside of your net tangible assets requirement or your requirements for your license, we don't want to be storing assets in this entity. The reason being is building construction is a risky industry to be in, and things can go wrong, especially if you're a builder and you're using subcontractors and you're the head contractor. There's plenty of risk there that might be outside of your immediate control, which is why we then look at having a company or a holding company split in between our trust and our trading entity so that we can have our excess assets. So let's say our net tangible assets is 200,000, or we have to hold 200,000 of assets in this company, and we've had really good years. We're starting to really turn over, but we want to stay at the same revenue level, and we might be at, say, 400. Well, now we have the ability to pay a $200,000 dividend. Both of these two entities are the exact same tax rate, so we don't pay any tax on that. But now I don't have 400,000 up here. I'm limited to my 200. And then subsequently we split who the director is or who controls those assets for the same reason. If anything goes wrong with the nominee or the license nominee or the license owner on the individual side, that 200,000 is out of that immediate control of the building entity. And then we can make the decision, all right, what do we want to do with the 200 grand? Do we want to start taking it out of here via dividends and spending it personally? Do we want to look at prop dev? Do we want to look at long-term investments? This structure allows us to do that. And then subsequently, Josh talking about the SMSF, we've got a 15% tax rate on normal income and then 10% capital gains. So now we're thinking, all right, well, I want to buy a commercial premise because I don't want to be a tenant and I have to pay rent already. I can make my concessional contributions from the company here. I've got my carry forward unused concessional contributions. I buy a little property, and excuse my drawing, and then it rents it back to the main business. So again, it's a layer of asset protection. The commercial premise isn't owned by building trading entity Pty Ltd, nor is it in the individual's names. So it can be a really good long-term structure. And then the next point is obviously property development and how that falls into it. And we start looking at, and I think because I'm drawn on the screen. Oh no!
Look right over here. That's right. Yeah. I'll take hold of it for you.
We'll share your screen.
Yeah. So you can see that, all right, Jill?
I think. Am I still sharing?
Sure.
No, Josh is sharing, but we can see your wonderful drawings.
We can see your drawing. So the bolt onto this, because the real power in our tax system is getting structure right. Really powerful when you can get this right. So just to sort of put the line around this, this is what Dylan was just talking about, or part of it. There is an ability, and we've sort of done this upside down to what he was looking at before. But when you've got this holding company, building company, and the trust, you can start to bolt on extra parts of your group onto this structure. So particularly property development on here as well. So Dylan was talking about getting value out of this entity because of the risk. We don't want a whole bunch of value sitting here because it's just exposed. Paying a dividend up here. Now, if you don't want to pull the money out for fun time tickets and you want to reinvest it, the key thing is when you're in a company environment, so this property development holding company is a Pty Ltd. Division 7A only applies when you're pulling money out to shareholders and associates that are not other corporate entities, so trusts and individuals. So say we push the 400 up here. You see it now. So the idea here, and I'll keep rushing on here, is this entity, if it's not going to pay dividend out here, it has the opportunity to loan money down to the development company. So and because it's all in a company net, you're not exposed to Division 7A. And all of these companies are all taxed in the same tax rate. So this is the idea of starting to self-fund your developments. And then the money can be used in this sort of structure, doing developments and washing it around. There's a whole complex thing that we can talk through on this, but the key thing is the opportunities of having structuring are enormous when you've got it right. And then we can also look at other parts of the structure, particularly if you're a developer that buys multiple bits of land and tries to stack them up. You can do a bit of land banking as well, using trusts as a structure to that as well. So the whole point of what Dylan and I are just trying to show you here is that it's complex, but the opportunities are enormous if you get it right. So that's the key part to the structuring chat. And I think, Phil, we're gone through the core content now, mate.
Yeah, I think they're the main kind of themes that we wanted to cover today. And I guess, it's just one of those things that, and I hear the guys talk about this quite regularly, tax is just a reality. There's no point kind of burying your head in the sand. It's in some ways a marker of success that you're, starting to spin healthy profits and therefore they need to be dealt with. But it's not an area that you want to go on autopilot with. It's an area that really, as a business owner, you should be leaning into, trying to level up your understanding, working with people that can explain these concepts to you well, so that you can really, start to implement a much better strategy. Trying to meet with your accountant on a regular basis is a big deal too, rather than just a one-off at the end of financial year. It's really important that I guess you're putting some of these plans in place ahead of end of financial year so that you can make the most of those kind of opportunities. I wanted to just quickly, we're going to launch this poll here. And guys, I don't think we've had any other questions in there apart from some commentary from Julian on your artistic abilities. But
you say artistic?
I just wanted to launch that questionnaire there, that poll. more than happy to. We just can't answer very specific questions for obvious reasons in a forum like this. We're more than happy to give you a session for free. You might want a second set of eyes to have a look at what you're up to. These guys can do that pretty quickly if we've got the right information in front of us. It might be that you're just thinking about trying to get into property development or something like that. You might have had a really good year. There's a whole lot of reasons to look at this stuff. So please let us know if you want to have a consultation. And obviously with Build Xact and our other partners, Acid Co, on today, if you want to find out more about what they're up to and the products they offer, or training and support, any of that sort of stuff, then make sure you fill out a consultation request there. I'm going to share my screen just quickly, just to show. So we've got this ebook. We'll be sending that out to everyone after the show. You'll get the video recording as well as this ebook link. And then we're also going to, we've just refreshed our website too. So we've got all of the webinars that we do them every month, sometimes twice a month. Any of the tools that we release, like pricing calculators, those sorts of things, and blog content, you can find, and you can filter by topic now as well to find what you're after there. In terms of upcoming events, Josh was talking about buying equipment. If you want to do that from a finance perspective, our next session, it's actually one of our express webinars. They're half an hour. It's just, all killer, no filler. And we're going to be talking about equipment finance on that one with our good friends over at NAB. We also, Jules, I think we've got a session coming up with you guys on bookkeeping and trying to make sure that all your software is connected properly.
Yeah, so we haven't got the date set just yet, guys, but for those that are using Build Xact, we're going to be doing an updated bookkeeping session. So that's covering everything from getting those transactions into Xero. We're going to be using it for Xero this time. So Xero and then into Build Xact. So how that whole connection piece works. If you are using Build Xact or you think about using us and you want to know how that side of it works, definitely come along when that invite gets sent out. Also be touching on the timesheet stuff as well. Timesheets has just been launched native in Build Xact. There's some additional features that'll be coming, but we're getting ahead of just going through this. So yeah, probably about an hour, Phil. I think it probably took.
Yeah, I think so. We usually, that's sort of like the natural attention span of a human being these days. We're pushing it at about an hour.
But bookkeeping might even be less, but.
Yeah, Josh mentioned that property development webinar. You can replay that one as a good feasibility calculator in that to work out whether it's worth going ahead with a project or not. So check out that one. In our CFO webinars, the last one I wanted to mention, we're doing one on sales. Our CFOs get heavily involved in driving top line growth as well for our clients that they look after. So we're going to do a sales masterclass from a CFO perspective on how to build a high quality pipeline. So that is going to be coming out later in July. If you're on our email newsletter, you'll be getting notifications about that one. That's our next masterclass. All right. I think that is about it, guys. Thanks, Craig, for joining us again today. Always good to see you, mate, and keep fighting the good fight. We know what a wonderful job Hazard Code does out there in the market. Jules, mate, good to see you again. Welcome to Queensland. We're so glad you moved up here, mate. It's a pretty good day to be in Queensland today.
That's right. Yeah, no, I agree.
And to Dylan and Josh, thank you so much for sharing all of your expertise today, as much as we can in this format anyway. But hopefully people have gotten at least one or two things that they can take back to the business and really try and start to think about improving from a tax and structuring perspective. All right. Thanks for coming, guys. And we'll see you on the next session.
Cheers, guys. Thanks for having us.
Thank you, guys. Thank you all.
Thanks, everyone.
See you later. Bye.